Started here. Thank you all for joining us for our halftime report. We're happy to see everybody joining us this evening that took some time out of our lives to get an update from us here. So thank you all for joining us, and I hope you take some good information from tonight. Please feel free to follow up with myself, the team, respectfully about any further questions that you might have from tonight's presentation here. Again, I promise to keep this relatively brief so you guys can get back to your evening, and we will go from there. So as far as disclosures are concerned, this makes all the attorneys in the queue here happy, so just take a little quick glance at that. If you would not mind, please make sure you mute yourselves. If you do have a specific question, however, chances are if you have a question, somebody else has the same question, so feel free to unmute yourself and fire away any questions you might have. It's a relatively small group tonight, so a pretty open door policy we will put out there. So fire away any questions you might have. Okay, guys. So as far as the agenda for tonight, what we're going to do is we're going to take a quick look back at review of the first 5-6 months of the year. Second, we'll take a look at the potential market forces in the second half of the year, and then where are we now? And then finally, we'll take a look at what we believe will be for the remainder of this year and beyond. So let's take a look first at where we started. We hit market highs at the end of 2024. And right here, what we see is a snapshot of the S&P 500 index from January 1st of this year. And this only goes through May 30th of this year. Sorry for some stale data, but when we have to get things through compliance and get approval and other things, by the time we get to present it, it's a little stale. I do promise that I have some better news than what we have forecasted here. So all that being said, this is from January 1 of this year. Through May 30. And the reason we look at the S&P is because it's generally a representation of the United States stock market. International markets this year are actually outperforming the U.S. for the first time in quite some time. But nonetheless, what we're going to focus on today is just the United States stock market. So the S&P initially rallied at the beginning of this year and then declined in part to the administration's new trade policy. Dare I use the word tariff? So all that being said, that's what we experienced in the kind of beginning part. The first half of this year was kind of marked by three overriding themes. The post-inauguration enthusiasm, trade updates, and then subsequently trade relief. After the administration originally launched a new wave of tariffs, back in April, stocks had fell. The concerns on tariffs that inflation might be coming, it might influence the Fed's decisions regarding short-term interest rates, a rebound, began really after the White House announced a 90-day pause on tariffs. And subsequently, we've rode that kind of wave all the way up, and, we're approaching market highs as of market close today. The market actually closed today at 6,263.70, despite some conversations about President Trump replacing the Federal Reserve chair. That was just kind of rumor mill. So finished the day pretty strong, and or like I said, I'm mentioning hitting market highs, all-time highs. So what we have here is actually a forecast of where a number of investment banks predicted we would be at the end of 2025. So we talked a little bit about where we are now. And as I mentioned earlier, we're at 6,236. Each one of these banks, obviously a lot of household names here, predicted on average to finish the year around 6,628. So we're pretty darn close to hitting a lot of these expectations already. And we are, a little over 6 months throughout the course of the year here. So all that being said, we hope that we can continue to run on this rally and hopefully exceed a lot of these banks' expectations for the S&P this year. This slide is rather unique because what this slide represents is the previous slide represents where they initially had mentioned, which is obviously illustrated over here on this side. And then over here, we can see the adjusted analyst predictions based off of April 24th, the tariff conversation. So as you can see, there's been a big difference in opinions after the tariffs were announced. But as I just mentioned on the previous slide, we are already exceeding their adjusted predictions because we're already at 6,236 for the year. Now, that doesn't mean that we're going to finish the year above where we are now, but with the fundamentals of many companies being very strong right now in the U.S. markets, I'm very hopeful that we're going to be through the majority of this tariff talk. So here's going to be the second half forces, and what we'll start with is some economic indicators. So these look like speedometers. Everybody should recognize these, and there's a number of different economic indicators that are up on this screen. You see monetary policy, labor markets, consumer spending, corporate growth. We selected June of 2024 because it's about a year ago. And as you can see here, a good majority of these are positive to neutral. So to put this in context, when we look back there, and we picked June of 2024 for two reasons. Obviously, it was about a year ago, and then also it was a few months before the presidential election. Back then, roughly 1/3 of the economic and financial indicators were positive, and then 2/3 were, only two of them were negative, though, and that was equity market valuation. And obviously, geopolitical risk is something that I don't think I've ever seen that positive ever in my entire career. But when we take a look as to where we were back in March, 9 months later, 4 indicators had turned from neutral to positive: monetary policy, the U.S. economic outlook, fiscal policy, and business outlook all went from neutral to positive. The only thing that changed really was housing slipped from positive to neutral. And this was after Inauguration Day, but before they talked of tariffs. Now let's fast forward again. June of this year, in just 3 short months, there's a lot more concern about the economic outlook. There are now 16 indicators showing a neutral stance compared with 11, the prior year. And the takeaway here is that indicators can change quickly. We're one headline away from economists predicting something different. And as you can see, based on the previous slides as well, economist forecast is just that. It's a forecast based on the information that we have right this moment. So all that being said, it's always nice to put this in context and use this as a indicator, but we can't let these types of reports impact our long-term financial decisions. We have to stay true to our core allocation. Here's a great chart mentioning inflation. On the left-hand side, we have year-over-year inflation. On the right-hand side, we have month-over-month. So when determining monetary policy, the Fed is tasked with a few things: supporting maximum employment, stable prices, and then moderate to long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators that the Fed measures itself on is consumer prices, which helps determine whether to adjust the interest rates. Typically, the Fed is comfortable with inflation at about 2% is the number that they're looking for. And the charts we're looking at depict consumer price inflation, as I mentioned, on a year-over-year basis and on a month-over-month. Right now, we're floating right around 2.7%. So it's a little bit higher than we like. And so there'll be some talk come July 30th when the Fed meets as to whether or not they're going to cut interest rates with inflationary numbers creeping up a little bit more than anticipated. It's probably unlikely that they cut, but who knows? Right now, the Fed and the president aren't really getting along too well, so we shall see what happens in July. But right now, like I mentioned, we're floating around right around 2.7. This is a great um, chart here that shows the labor market. The dark orange is job openings, and then the light orange is going to be the unemployment rate. And you see this spike up here. This is during the COVID pandemic. So obviously there was a lot of unemployment at that time. Weren't a lot of job openings because we didn't know what was happening at that point in time. Then we subsequently saw the unemployment rate kind of jump up, but now it's kind of stabilized a little bit. So the labor markets continue to improve, since coming out of the pandemic. And the labor market is an important support to the overall stock market because consumer spending is one of the main driving factors in economic and stock market growth. So, if everyone is employed and we have low job openings, that means corporations are hiring and or are fully staffed, and we have less unemployment. So when you see job openings going down and you see an increase in, a decrease rather in the unemployment rate, those typically bode well for stronger economic growth and goods, and subsequently good stock market growth moving forward as well. This is a funny slide, so not necessarily a funny slide, but tariffs have been around for a long time. Okay, this is not something new. It goes back for over 2 centuries, and is not unique to just the United States, but worldwide. But this slide I really liked when we were looking at this because the buzzword tariff has been in the news headlines for quite some time now, and as you can see in Q1 of 2025, 411 of the 500 S&P 500 CEOs were talking about tariffs in their presentations during their quarterly reviews. So I found that to be a pretty unique slide. And, these buzzwords that come out that really the media will definitely not necessarily embellish, but really, really use to stir up emotions of investors. It's so prevalent now in the Twitter world that we live in that, people just want to deliver messages quickly and they want to stir up emotions. It gets clicks, it gets all the things. So 411 of the CEOs of the S&P 500 companies were using the word tariffs in their conversations. So where are we now? The next slide, we're going to talk about a couple potential headlines as to kind of where we are. So let's take a moment to consider the variables that may weigh heaviest on the market performance for the remainder of this year. First is trade policy. Obviously, tariffs. Markets hate uncertainty. And as I mentioned in the previous slide, it's not necessarily that there were tariffs that were going to be implemented. It was simply we didn't know what the tariffs were. How extreme were they going to be? Were they going to be across the board? So the uncertainty is really what drove the market kind of correction we experienced in the first half of this year. So that's one of the main headlines that we're going to be focusing on here. Another variable is the overall economy. The Fed is engaging in balancing act between managing inflation, looking at the job market. So as we move into the second half, we may see which decision they make and whether or not that's going to work out in the market's favor or not. Like I said, it's very based on the reports that I've read, it's very unlikely that we have a major cut in July's meeting. At least we'll have to see where the inflation numbers come in at. And then finally, the artificial intelligence. That's another driving component of a lot of different industries. So we'll continue to take a look at how the innovations in the AI field continue to drive market performance and continue to innovate all these large companies. So the overall level of economic activity, may play a role in how the financial markets perform in the coming quarters. This chart here is put together actually by the Federal Reserve of Philadelphia. And to gain better insight into how a lot of economists think the economy will perform, we took a look at the May of 2025 survey from the Federal Reserve of Philadelphia. And let's look at three specific factors here. GDP growth, unemployment, and then core CPI. So as you can see in the charts, the consensus view as of May 25 is that gross domestic product is expected to be between 0 and 1.4%. Initially, they predicted about 0.5% in the first half of the year, and then 0.9% for the second half. So that puts us around 1.4% GDP growth, below historic norms. So not a lot of GDP growth predicted here. But other professionals are projecting that the unemployment rate will creep up to a little bit higher of a level. Most recently, the unemployment rate dropped actually from 4.2% in May down to 4.1% in June. So again, something to take into consideration here is that, forecasts are just forecast, but this is what the Federal Reserve was forecasting earlier this year. Now, the personal consumption expenditures index that's listed all the way over there on the right-hand side, they're estimating it's going to be around 3 to 3.4%, which is actually up 2 brackets from the prior year. And that's something that the Federal Reserve is really focused on, because that's what drives your inflationary components. So if inflation stays high to slightly above the normal range, which we're already above that, it's very unlikely for the Federal Reserve to cut rates dramatically coming up in the July meeting. So. Sorry, everyone. So some market strategists look at a number of different types of fundamental indicators. This one that's illustrated here is the bottom up earnings per share approach. And I'll explain this a little bit. So the bottom up earnings per share, they focus their attention on estimating earnings for all of the S&P 500 companies. By contrast to the top-down approach, and investing target prices places a greater emphasis on macroeconomic factors, so big picture things, when making an investment forecast. And in this chart, you'll notice how stock prices have been trending flat to higher, while corporate earnings are kind of more mixed. When evaluating this chart, it's important to remember that stock market is considered a discounting mechanism, which means that it's always looking forward. And it's looking forward about 6 to 9 months. And when I say looking forward, what I mean by that is all the information that is currently available to us are forecasts as to what we believe the stock market's going to look like about 6 to 9 months from now. So looking at this continued growth in the S&P, I think that we're poised for a little bit more of a little runway here, and hopefully we continue to grow here. Right here, what we'll see is some earnings here in each of a number of different sectors here. So we see healthcare, utilities, financial, real estate, industrials, and there's only 3 or 4 here that are actually predicted to be negative for moving forward. So 11 of the industry sectors are here. Third from the left on this chart is overall earnings of the S&P. So when we look at earnings, we're looking at about 5.1% as of today, where at 9.3 was back in March. So still relatively strong earnings predicted for the year. And as we continue to see a lot of the growth here from coming out of the little market dip we had earlier this year, the earnings are pretty strong in a lot of companies that are driving market performance right now. So very good earnings moving forward, and hopefully as well. This slide was a pretty neat thing. So I actually have to read a little bit about this to you guys because this is one of the first times I heard of this sticky inflation, right? So I'm going to read this verbatim. One aspect of inflation in particular focus for the Fed, as well as market analysts and economists, is what is called sticky inflation. Sticky inflation refers to the components of the consumer price index that have historically exhibited a greater rigidity or stickiness with respect to price changes. In this chart, 12-month sticky inflation is the orange line, while 12-month CPI is the gray line. Now, sticky inflation includes a couple service-based categories, including medical services, education, personal care, as well as most of the housing categories. And that kind of makes sense to me when I look at, prices that have increased, coming out of the COVID pandemic. You go out to dinner, you go out to the grocery store, while inflation may have come down a little bit, it's still expensive. And so those sticky type services are really keeping the CPI a little bit higher than what is being reported, because this is what's reported, but what we feel is very different from what is being reported. Because there's a number of individuals out there that I know that are looking for homes. The younger demographics that are graduating college. We have that boomerang generation that they're moving back in with mom and dad, and they're looking to buy a home, but it's just the price points now are just so high that it's hard for a young couple or just a young individual to get started and buy their first home based on the current prices of houses and groceries and furnishings for the home. So that sticky CPI is what's being really stubborn right now. So what's ahead for short-term rates? I mentioned earlier that the Federal Reserve has formal meetings this year, actually. July, September, October, and December. They will be meeting in Jackson Hole, one of my favorite places, coming up soon. But for the July meeting, I'm not sure what's going to happen. Again, press release today was that there's probably not going to be any major movement with the interest rate environment, despite the pressures from President Trump right now to lower the rates. So we'll see what they do, but obviously short-term rates can impact the market in a number of different ways. One of those ways is bond yield. And I'll give you an example. As interest rates rise, bond prices come down in value. And I use this example for clients oftentimes. The U.S. Treasury, or 10-year Treasury, that's known as the risk-free bond. Okay, why is it risk-free, or why is it referred to as risk-free? Because the coupon payment that bond generates is guaranteed by the full faith and credit of the U.S. government, essentially the taxing authority. So if they can't service their debt, they're just going to tax us. So all that being said, let's just hypothetically say the U.S. Treasury is 4.5%. Okay, you're looking to take some income from the portfolio or from your respective portfolio. So you're looking for some type of yield on that investment. You want to protect principal, but you want to take income from it. So let's just say it's $1 million bond, and you were to put $1 million into it, and if you use the Treasury, you're getting 4.5%. Well, that's great because that's $45,000 a year of income that you can kind of peel off of that one bond and use that for your spending. You don't dive into principal much for that, and you can have a very, very strong, standard of living based on combining that with your Social Security and possibly a pension, all those things. But as bond yields go down, a corporate bond that may have been issued, or I'm sorry, as the let me restart. As the Federal Reserve increases rates, that risk-free bond becomes even more attractive. So if you may have bought a bond at 5.5, which was a full 1% above the Treasury when you initially bought it, that becomes less attractive because as the risk-free investment goes up, why would you take any risk in the fundamentals of a corporation when you can get this guaranteed bond on this side that has no risk? So the only way you can do that is if you can buy that bond at a discount. So you see bond prices come down as the risk-free rates go up, and then vice versa for if bond prices or the yield comes down. That's where bond prices go up. Okay. Sorry for that confusion there, guys. So one of the things I mentioned earlier is just really staying focused on the fundamentals. Okay. This next slide here is going to show you what the average bull market is versus the average bear market. Okay. Bull horns go up. That's the bull market's. Bear, you slash down. That's going to be when the market goes down. And this chart shows, an analysis of bull and bear markets from 1942 through 2025. The first quarter of 2025, sorry. And here you see that the average bull market lasts about a little over 51 months, so a little over 4 years. Whereas on the flip side, the average bear market lasts about 11 months. So, you have a lot of individuals out there that sometimes want to try to time the market. And it's so hard to do because it's really hard to pick when the right time to exit is and when the right time to enter is. When do we cut out here when we're up 150%? Well, then we just missed a 70% swing, back in the 1980s here. Do we cut out here during the tech bubble? Do we get out 400%? Is it 410? Is it 415? You just don't know. So it's so important to have multiple asset classes in your portfolio and have diversification because if time is on your side and you have a long-term investment strategy, you will continue to grow your net worth despite the volatility associated with this. Now, it's always important to have access to capital and specifically maybe 6 to 12 months of cash reserves so that if in the event there is a market correction, which on average, as I mentioned, is about 11 months, you have access to some dry paper to where you can go grab from something that's not down, during the need to where you might need to pull from something. Okay. So I always found this chart a little interesting here. And then last but not least, one final note here is that it may be helpful to remember that, volatility is part of investing. And I just alluded to that in the prior slide here, but this table shows that more than 7 times a year, investors should expect pullbacks of 3%. Okay, on average, 7 times a year, you're going to see the market drop 3%. Okay, at least once a year. Okay, and then at least once a year, you should be prepared for a 10% correction on average. 5% correction, 3.4 times per year, 0.5% correction, or I'm sorry, 15% correction, every other year, and 20% correction, 0.3 times per year. So these two larger ones, I like to see from a probability standpoint, they are lower, but volatility is normal in the stock market. It's not going away. And it's been present for the history of the stock market, since 1928. So all that being said, volatility is part of the game. That's why we preach diversification, making sure you have access to capital during all kinds of different market environments is important. Diversification, touching different asset classes such as small cap, mid cap, international exposure. International is up over 15% for the year, whereas the S&P is actually lagging for the year. As I mentioned, this is kind of the first time in quite some time. So all that being said, thank you again, guys, for joining us tonight. There were no questions during the immediate presentation, which allowed me to get through this relatively quickly. I said 20 minutes. I went 32. I'm very sorry. So being respectful of each and every one of your times, I'm going to go ahead here and close the slide here. and I'm going to open it up for some Q&A. I know my team is on here as well, so if someone asks a question and the team wants to jump in, please feel free. But I am going to be done sharing my Bluebird with everyone. Questions, concerns, like I said, please don't be shy. If you have a question, chances are somebody else might. And if you want to discuss in a more private sector, just please feel free to reach out to us individually, and we're happy to answer any calls you might have.
Dean, this is Dave Kelble. How you doing?
Mr. Kelble, how are you?
Great. Any thoughts on the level of consumer debt? Since the consumers are the major driver of the economy right now, I'm hearing that the level of debt that the consumers are having is quite high. Any thoughts on that?
So there is a record. I just listened to Caroline and I were listening to the BlackRock forecast today. There is actually record cash on the sidelines right now. $7.1 trillion sitting in dry paper. Now that's the polar opposite of consumer debt, right? You have a lot of dry paper on the sidelines. Consumer debt, though, is certainly going to be an issue. One of the biggest sectors for that is going to be your student loan debt. How do we address consumer debt?
Do you see any headwinds for the economy if the consumers continue to have as much debt?
So, can you hear me, Dean?
Yeah. Larry, you want to take this one?
Yeah. So one of my friends is has a mortgage company, and he's been talking about consumer, and he's doing whatever 20, 30 mortgages a month, and for the last say year and a half, he's been talking to me about consumer debt. Almost everybody comes in, whether they're making $50,000 a year or $500,000 a year. There's large amounts of debt. People taking home equity loans, capping out everywhere. But it's been going on for a while, and it seems like it should be slowing up consumer spending, but it is not. It is not happening. And it's not really getting worse. Like it's not like this month compared to the same month a year ago, the debt ratios of the people coming to him for mortgages are worse. He said it's just the same. Like almost everybody has high levels of debt, and as best he can tell, people are, as long as they're not defaulting on it, and they can continue to spend like they're spending, and the economic numbers show they are, that it seems as though at some point we're going to come to a head with the consumer debt. And I would imagine the first place we're going to see it is consumer spending. If that happens, that's obviously going to affect corporate profitability. And, that ultimately will create a problem in the stock market. But it doesn't, as of right now, it doesn't seem to affect spending. And I think it's because a lot of the spending going on is from people that, are on the high income side, and they can afford their debt service and still continue to spend money like they're spending. Now, the people who, are on the lower half of the income scale probably weren't having large effects on the stock market anyway. And the fact that their debt, have debt up to, over their limits on what they can afford isn't really affecting the economy. So me and my friend literally talk about it every week. And that's our analysis when we chat about it, because when he tells me, he goes, I don't understand how the stock market's not crashing. Everybody who comes in here has, virtually no equity in their home. Their credit cards are maxed and their home equity lines are maxed. Yet consumer spending just keeps rolling along. So I don't know if that helps or not answer your question, but it seems as though it should be a problem, and it's not, which tells me that there's enough spending going on above these rising consumer debt limits that it has not impacted in a meaningful way consumer spending. And as long as consumer spending is fine, The economy is going to be fine. And quite honestly, if Trump and the Fed, if they're able to execute on a plan to start lowering interest rates, that'll actually create room for even greater consumer debt
Yeah,
and government debt and debt across the board. So
Yeah.
and I do think,
I don't know. It seems like it should matter, but it doesn't.
yeah.
So
Larry, to just piggyback off of what you just said right there, which is very, very impactful. Dave, I acknowledge that, debt is certainly an issue. Especially it's hard to make the day to day. Especially when you're getting started. Whether it's a recent college kid that's trying to service their credit card debt, get a card, pay their stuff, pay their two-bedroom apartment. The wage growth there just wasn't necessarily keeping up with the inflationary pressures coming out of COVID. So it's very very hard for the younger generation to get ahead, which is why you're seeing that boomerang generation where they move back in with mom and dad. So, new homes in that age demographic are certainly not. They're not going. Your average home buyer now has gone up significantly to I think the early 30s. But a lot of individuals too, they don't want the home ownership. They don't want that. They want to rent. So when you poll different individuals, they don't want the headache of the HVAC going on them, or replacing a roof, or mowing the grass, or things that they want to go live. They want to travel. They want to do this. They want to do those things, and that's where it's really driving the consumer spending.
Right.
But no, I definitely acknowledge that there are levels and debt levels that you look at it and you're like, how is this even serviceable? So provided they start defaulting on the debt, I would say that that's going to be a problem. But to Larry's point about lowering the interest rate environment, if
That should help, certainly.
correct, you can lower the interest rate environment. First of all, I know myself, there are a lot of individuals I know, obviously sitting on our side of the table here, that, they got into homes at a higher interest rate environment. I have people that came in though that, we would, when rates were below 3%, heck, we took advantage of a refinance. And, they're 2.75% on a 30-year mortgage now. Those people aren't going to get out of those houses for forever if they don't have to, for job change or, downsizing or whatever. So they're going to be very comfortable in that because servicing that debt is so low. But if interest rates do correct, you're going to see a mass. You're Larry, the gentleman you mentioned who's in mortgages, he will be happy as pie because he's going to have an absolute flood of individuals that are looking to refinance their homes, which in turn will provide them with better cash flow, and will drive some additional consumer spending. So for those individuals, Dave, that are servicing their debt, and it's continuing to grow, I don't necessarily know that. And I'm just spitballing ideas here. I don't know if it's necessarily new debt, but it might just be that the interest rates are so high on that debt to where they're just treading water and they're paying, paying Rob and Peter to pay Paul, doing balance transfers, and then getting higher. So, but that is, certainly something that at the government level they've been trying to combat the student loan debt, because that's the second biggest debt there is, right? So, and that's just kind of that trickle down effect is there. I have not heard of any type of government intervention that's going to actually combat, frankly, maybe poor parenting, and not allowing people or teaching the younger generation to live within their means. So all that being said, that's the complete separate topic. But one of the classes that, and I know my alma mater, Sinus, and Joe as well, they are trying to teach financial literacy classes in the district. So, or not in the district, but at the university. So, one of the things that I do is I'll go in there and I will try to teach these kids about what spending is, and how to do a budget. And a lot of the individuals, even on this call, have referred their children to us, and we've had some conversations with them at an early age. So, I think this is a true testament to getting started early, becoming financially literate, and making sure that you live within your means. Because to your point, Dave, it's incredible sometimes what you see. So, but as far as kind of how to combat that, I don't know that there's actually government intervention programs for you, unless you're in a very, very low income bracket, which to Larry's point, those are probably not the individuals that are really driving a lot of the higher level consumer spending.
Just a concern of what what could impact the.
Very, very, very valid.
Yeah, yeah. Okay. Well, thanks, Larry. Thanks, Dean.
Jim just actually put in the chat, another tailwind, and as far as consumer spending, are some of the tax relief that just came out with the new bill that was signed in there. The tips on that, and then Social Security tax credits as well. So those are maybe some of the programs over time as well. So Jim, thanks for diving in on that as well. Any other questions that anybody has out there? All right. Well, guys, I would like to thank each and every one of you for joining us tonight. We took 45 minutes of your evening away from you and your family, so we appreciate you being part of the call. Look forward to talking with you guys sometime soon, and enjoy the rest of the summer months here, and make it a great day, guys.
Thanks, Dean.